The greatest stock market divergence is observed in the history of the United States stock market. The question is, do you know how to trade this and profit from this? In this video, we're going to talk about the facts. And at the very end, we will reveal highly controversial trade that the entire media have brainwashed you to actually overlook. With that said, in this video, for the purpose of keeping it short, we're only going to be able to touch the iceberg of what is actually going on with multiple divergences, which, if we combine them all together, presents the greatest divergence of all time. Without any further ado, recently, just a few days ago, from official site of Atlanta Federal Reserve Bank, they're projecting the GDP for the next quarter to just be 0.3%. That is officially down from 1% just not so long ago, literally about 10 days ago. That is a decline of 70% in projection. So as you hear all the great stuff in the news, this is what's actually taking place. These numbers are deteriorating fast. Just take a closer look. Expenditures, personal consumption, expenditure growth. They're revisiting these numbers lower as well, from 2.1 to just 1.7%. Fourth quarter real growth, private domestic investment is decreased from minus 2.3% to minus 4.4% respectively. Guys, does this sound like the greatest economy of all times? Guys, for those of you that are new and just trying to learn some basic stuff, GDP is known as the main economic indicator of the economic activity. So if you take a look at the actual chart, the numbers are deteriorating fast. What the is going on here? Now, here's something you should know about Atlanta Fed. You're not going to believe this. Yes, Atlanta Fed is 99% wrong, meaning that in majority of the cases, they're too damn optimistic in their forecast. What do you mean, Leonardo? They just slashed it to like 0.3, basically a zero. Well, in most cases, the actual GDP number actually comes lower than the Atlanta Fed projects. So the next GDP number is going to be around zero. It can actually be negative. So here's the simple question. How the hell do you have zero GDP while unemployment is at 50-year lows? Yeah, since 1969, and we supposedly got the greatest economy ever. I mean, there's a couple of scenarios. Well, number one, clearly you could say, well, the numbers are fake. They're not real. Donald Trump was saying that the unemployment numbers were fake when he was running for the president. And he said Obama's unemployment numbers were fake. Well, now he says they're real. So what is the case? Well, let's assume and give him the benefit of the doubt that they are real. So here's the chart of the unemployment rate in the last 50 years. There we are. And considering that this is the case, here's the divergence. If the unemployment is historic lows, why is the main economic indicator, gross domestic production, gross domestic product, is going lower and deteriorating at the speed of light, while the stock market is hitting all-time highs? This is a beautiful set of divergence and becomes even more relevant if we take a closer look. The divergence is also seen clearly between the unemployment and the GDP. They are both going lower. Now, if the unemployment goes lower, clearly the GDP should be going higher. Otherwise, what the hell? Pretty much everybody is employed, but the gross domestic output is not increasing. The question is, what are they doing at work? Drinking coffee? What are they doing? Watching Netflix? If everybody is pretty much gainfully employed, the typical correlation between lower unemployment and GDP is they're supposed to go in the opposite directions, but not in this case. So the question is then, what do you think will happen to the GDP or the economy overall if unemployment rate begins to climb from here? Officially, 13 Market Moves, Trading Options Live, we identified that this was the bottom of the unemployment rate at 3.5%. And from here, it will only go higher. In other words, we will see an increase in the unemployment rate. So if that is the case, this is what's going to happen. The typical correlation will be renewed. The typical correlation that we have seen throughout the United States history between unemployment and GDP will be renewed. So you're going to see a spike in unemployment, and the GDP rate is actually going to drop substantially lower from here. Now, that is a contrarian view right now because everybody's actually expecting the unemployment to stay at these low levels, and everybody is expecting the GDP to go higher. So if you take this contrarian view, you will be able to nail some unbelievable trades over the course of the next 12 months. You may say, Leonardo, who cares? Come on, man. Leonardo, you should know better. Federal Reserve is pumping money in the economy at super fast rates. So none of these GDP slow down stuff matters. The economy will be fine. And that's why, we shouldn't be worried about it. But guys, here's the truth. Yes, the Fed is renewing the QE for the last 3 months. Here's the balance sheet for the Federal Reserve after doing some quantitative tightening. It's back and providing liquidity for the markets, up $290 billion in the last 3 months, guys. This is for the months of August, September, October, and some of the November right here. Guys, at astounding rates, the Fed is back on the QE track. Now, the question, how far will it take us and what kind of impact it will have overall? So even though we could say, yeah, everything's going to be fine, that's why the markets are going higher, the reality is this. That is exactly why this situation is highly concerning. With all the renewed activities of QE and the lower interest rate environment, the economy is failing to grow. That is exactly the reason to be worried. In other words, all the extra injection in the economy is not having the same type of effect that it had in the prior years. In other words, the law of diminished margin utility, which we're going to explain later in the video. Now, maybe instead of listening to the news and what we're saying, how the economy is great, we should start listening to what the actual companies are saying. Here's a couple of quick examples. Home Depot is actually lowering the sales expectations and earnings forecast for next year. The report just came out at about 6 a.m. this morning, November 19th, 2019. Yeah, Home Depot did beat on earnings. And how can it not beat on earnings? The freaking expectations are so low, okay? A 2-year-old can beat it on earnings. Now, the bottom line is, look at the reaction of the market. Yeah, the stock is down, but now they're starting to buy the dip. Going 3 months forward, we're not going to be seeing this type of behavior. The stocks are going to be dropping, and it will continue to drop later because there's going to be more and more instances. And despite of the QE, despite of everything, it's not having the same impact as it had before. And once all the institutional investors are going to catch up to that, we're going to see some substantial drawdowns in the market. Now, this is not just the only suspect of the day for a slowing economic projections for next year. And Home Depot did lower its sales forecast and earnings forecast for the next year. The second suspect of the day announced earnings slightly after Home Depot did was Kohl's, another retailer. Yes, Kohl's also lowers its sales and earnings forecast for the next fiscal year as well. The stock is down. I'm sure they're going to buy the dip, pull it back up, but this one is destined to head lower, guys. With this said, this is just the iceberg. We're just touching the iceberg here, guys. So there is a highly lucrative trade I'm going to show you at the very end. Leonardo, come on, man. We're going to get a trade deal and everything will be fine. Everything will be fine. There's nothing to worry about. Yes, actually, everything was fine before Trump decided to begin the trade war. This is what China was actually buying as far as the agricultural purchases. We're getting close between 17 and 20 billion. Now, the best outcome if this hypothetical phase 1 deal does get inked is we're going to go back to this level right here. Now, what nobody's actually talking about is the billions of dollars that we lost as a result of this trade wars that will never be gained. What else is nobody talking about is this is actually the best case scenario, because nobody seems to mention the invisible impacts of the trade war over the course of the last 20 months, which is the fact that China is becoming less independent on the United States by making key economic and business partnerships with pretty much every country in the world besides the United States. As this economic relationship flourish and progress, there's no gonna be any way to get those relationships back, definitely nowhere near short time. It also creates a highly negative sentiment between the citizens of China, so they're less likely to invest in the United States, they're less likely to travel to the United States, they're less likely to spend any money with the United States. Now, the magnitude of all of these things is at this moment uncalculatable precisely, but it is going to be devastating. As a result, China is buying more products elsewhere, and not just agricultural products. Okay, so far the focus of the fight is in the agricultural area, and Donald Trump is definitely losing this fight. We've actually made a separate video specifically underlying all the details of this. Initially, the trade deal per him was the fact that they were going to buy 50 million, and we actually laughed at it and said there was no way they're going to do it. At this point, we're talking about 20 billion, and the prospects of that are not looking good. With that said, here's the worst case outcome, guys. Yes, there is actually a worst case outcome in this trade deal, and the fact that there is going to be no deal. The chart of soybeans points clearly that the United States is not winning, unfortunately, this trade war. And the chart of soybeans clearly points to the fact that there is going to be no trade deal. In expectation of the trade deal, soybean prices typically would move higher. But anybody that understands the details of the trade deal clearly knows that there is no deal. This is why the prices are dropping like a rock on some high volume. Now, here's another myth that you keep hearing all over the news, is that the United States consumer is strong. In this chart, we're going to bust this myth right now. What you see in this chart, guys, is a representation of United States consumer revolving credit. So when you see like Amazon Prime Day, as pointed out right here, everybody basically pulls out their credit card and they go and they buy stuff. Now, as soon as these promotional offers are over, okay, we see a substantial drop in consumer actually buying anything. So what we're really seeing on this chart, okay, is very uneven activity from the consumer. When the consumer is strong, they don't even have to pull out a credit card to pay for stuff. This chart clearly represents the following. Consumer waits for big sale days to pile up more credit card debt. Now, if you really think about it, how healthy is it really? Highest level of credit card debt and home equity loans in the history of this country. Now, that is a result clearly of cheap money. Now, it's easier to spend, borrow money. Cheap money simply creates temporarily artificial demand which otherwise would not exist, which is the opposite of a strong consumer. Now, here are the facts. Corporate debt versus GDP exceeds the levels before collapse of the stock market in 2008. In 2008, corporate debt represented 44% of the GDP for a total of 6.6 trillion. In 2019, it represents 48% of the GDP, around $10 trillion figure. Now, here's the interesting chart, probably the most important chart out of the charts that I've got in the short video. Last time, we had things blow up between the 90s going into the tech bubble of the 2000-2001. As you can see, from 1990 of this red dot, we slightly increased to this red dot right here, followed by a tech crash. Since then, we had similar circumstances where the next red dot in the corporate debt levels is slightly higher than the prior dot of the tech bubble, and what we get right around this time frame is the real estate bubble bust and the crash in 2008-09. Now, similar circumstances developing right here on this chart. Yet again, we're slightly higher on the corporate debt level than we were in 2008. Also important to notice that all of these things are spaced out roughly between 8 to 10 years. Yes, we are talking about a basic credit cycle here, and it is about to bust. Now, the bigger issue with this is the reinforcement of cheap money creates false hopes for companies to rely on cheap money. Some of these prices over the course of the last decade has really been sustained by institutions being able to scoop up their own shares in record-breaking buyback deals. Now, for the first time ever, we are actually seeing a slight decline in the buyback, which with the exact circumstance that was preceding the crash in 2008 and 2009. Now, with that said, once this cheap money is available for extended amount of time, certain companies, not every company, but certain percentage of companies, they build out their business model relying on the access to cheap money. So the moment the cheap money is no longer cheap, which is exactly what's fixing to happen over the course of the next 12 to 24 months, even small rise in interest rates, which will happen as soon as the dollar depreciates, will cause massive layoffs and record bankruptcies because companies are not going to be able to sustain their daily operating activities. Basic law of economics, guys, the law of diminishing marginal utility applies in this situation in such a way that even though you do see the increased QE activities from the Fed and the lowest interest rate, okay, with each additional QE action or further interest rate cuts from the Fed, the impact of such actions is decreased. And that's said by me, Leonardo, TradingOptionsLife.com. Maybe one day this will be somewhere in the textbook because nobody wants to actually take this seriously at this point, but the basic laws of economics don't lie. And pretty soon we will see almost no impact of this QE type easing situations, and lower interest rates are not going to matter because of the law of diminishing margin utility. Guys, with that said, here's the controversial trade. While everybody is bullish on US consumer, we just showed you the chart that busted the myth of the US consumer being strong. So short the hell out of the retail sector today. There's plenty of stocks that will be announcing earnings this week from the retail sector. Majority of them will drop as soon as they announce earnings. So with that said, make a bunch of money, guys. Trade like a rock star. To get more details on specific option trades daily, click the links under this video. TradingOptionsLife.com, and subscribe. In the next video, we are going to talk about when is the best time to short the stock market. Let's roll. I'll see you guys in the next trade soon.
Trading wins and losses is just like everything else in life that is worth fighting for. You remember your marriage? Man, it was beautiful when you were getting married, but you had no idea how ugly the losses of this divorce were actually going to be. Like opening a business, thinking you'd get rich overnight. But in the midst of it, you ended up maxing all of your credit cards just to sustain that business for a few years before you even realize a tiny bit of your first profits. Like buying a house thinking it would go up in value forever and ever. Just realizing how wrong you actually were when 2008 hit. Like having kids, it was such a great idea at first. Remember how excited you were, terrified and scared at the same time, how much joy you actually had. Until your kids turned 2. Man, the terrible 2s. You thought that was bad until they turned 13, 14, 15. Shit. But you wouldn't change it for anything. You love your kids, no matter what your emotional losses or wins are with them, no matter what your financial losses or wins are. It really doesn't matter, does it? You don't quit on your kids, no matter how tough things actually get. For some of us, it's the same thing with trading. Just think, how long are your kids going to be your kids? The answer is forever. How long do you see yourself trading the markets? If your answer is forever, then you owe it to yourself and your kids to invest in the 13 market moves formula, so that your life journey of trading would be most rewarding and joyful, both financially and emotionally. Live to trade, trade to live. Conquer the world one trade at a time, fearlessly using the 13 market moves formula today.